This episode of the BIG5D Podcast is sponsored by Duda. Every 17 seconds, a new website is created on Duda. Partner with Duda to build high-performing websites at scale while reaching higher productivity with a customizable platform designed for agencies and SaaS companies. To learn more, please visit duda.co. That's duda.co. Welcome to episode 38 of the BIG5D Podcast. I'm your host, Charles Laughlin, Content Director for Big5 Digital. Our guest is Zach Marks. He's the co-founder and CEO of GIA, a blockchain-based small business lender focused on emerging markets in Africa and Asia. GIA recently raised a $4.3 million seed round, but we don't talk about funding at all on this interview. As I told Zach before we started recording, my view is that the amount of money a company has raised is usually the least interesting thing about it. Not that funding isn't important, we all know it is. We're just much more interested in which problems a company is trying to solve and how. We really hope you enjoy this interview with Zach. Zach, welcome to the BIG5D Podcast.
Thanks so much, Charles. Happy to be here.
Great. So your company is GIA. Is that pronounced correctly?
That's right.
So usually the first question is, what is your company? And so what I ask is, what is your company? But in the course of answering what is your company, maybe the name, etc., tell us about your mission.
Sure. So what GIA does is provides blockchain-based financing for small businesses in emerging markets. And our mission is really to unlock financial freedom and put entrepreneurs in control of their financial destinies around the world. Since you asked about the name, I think it's a good place to begin. GIA is actually sort of an homage to our team's multicultural background and multilingual background. In Chinese, my co-founder's from China, and in Chinese, Jia means home or family, which we think is the central financial unit. In Hindi, Jia, and I lived in India for about 4 years working in microfinance. So Jia means heart, and we think of this as building banking with a heart. And finally, in Swahili, which some of your members might be familiar with, in GIA, so GIA with an N in front of it, means road or path. And we're really building the road or path to financial independence for small businesses. So that's how we got our name. And happy to go into the background of why I started it and who I am.
Yeah, well, the name, there was more to that than I thought. That's pretty cool. Tell us, you're a co-founder of this company, and I want to get into the whole blockchain, all that stuff that you started with. But before we get to that, what is your path to emerging markets? I know this is not exclusively Africa, it's an emerging market play, right?
Yeah.
But what is your path? You mentioned India. Kind of what is your path here?
Yeah. So, I was born and raised in Philadelphia, so not an emerging market, but I've really always loved...
I'm from Chicago. Neither are.
Yeah. I've always loved learning languages and always really loved connecting with people over food. And I think some of that passion made me know that I was going to work internationally once I finished college. So my first job after college was teaching English, since it was a way for me to hop around the globe. Mm-hmm. And so I taught in schools in Brazil and in Ethiopia and in India, sort of how I first started hopping around the world. And in each place, I became really good friends, usually with like the street vendors in my neighborhood. And in India, I was pretty close with the chai wala, the guy serving samosas and chai outside my school. And it's a guy who's working hard to make a living for his family and even provides employment for folks. Runs a good business, and he wanted to expand and have a second stall, and he just could not access financing to do that. And that's, small business financing is a real challenge in the US as well, but I think it's particularly challenging in emerging markets, and sort of trying to figure out why it was such a challenge is what led me into the work I've been doing. And so ever since hanging out with Ramesh, the chaiwala, outside my school, I sort of began work in what I'd call basically 3 waves of microfinance. If we think about what this core challenge is of like, why can't we get Ramesh, the chaiwala, a loan from a bank? An Indian bank would say, well, there's a couple main challenges here. A big one is I don't have any data to underwrite this person. I have no idea how many cups of chai or samosas he sells in a day. Another big challenge is just he's probably not worth my while. Just he's so small. Maybe he needs $500 of financing and milk and sugar and whatever, another $1,000 to open up a second stall. It's just not costs me more than that to go and serve this customer. And as a result of those challenges, and there are probably a handful of others, but there's really two main ones. We have a $5 trillion credit gap for small businesses in emerging markets. And that really became the defining challenge of my career. So I began working after I was teaching. My first job, I was working in what I call microfinance 1.0. So this is working with traditional community finance groups. They have different names, different parts of the world. And in East Africa, they're often called chamas or sometimes SACCOs, a saving and credit cooperative. In West Africa, you have susus, and in Mexico, you have tandas, different names, different places. But the general concept of these groups is people are saving and borrowing together in a common shared pool of money.
These are often community informal organizations, or both. Say more on that.
So the sort of the Grameen Bank model is often to work with what are existing informal community organizations, like as informal as, hey, there's 10 farmers in one little village, and they all sort of get together on a weekly basis, but maybe they don't have any legal entity. Or it could be as formal as, the Philadelphia Farmers Credit Union, in which case it is formalized. But
by informal, I meant like not a legal entity.
Yeah.
More of a collective of individuals.
Yeah. In general, the idea is just a collective of individuals, and it can be formalized or cannot be. But what works about these things is people have this sort of shared community ownership and interest, just like a cooperative. What's really challenging is for the groups to scale. It's very difficult for them to grow beyond, say 20 or 30 or hyper local group. It's very expensive for microfinance institutions to serve them. It's very difficult for them to access capital beyond their communities. And so in search of something that would scale a bit more, I moved into what I think is like the second wave of microfinance, working in the world of fintech. I joined a company at the time. It was very small. It's called Tala. It's really a pioneering company. It was the first company to do mobile loans. So now around the world, there are probably hundreds, maybe even thousands of companies that do this. But back in 2014, Tala was the first company to come up with the idea that, let's say there are 3 billion people in the world without a credit score. Many of them have cell phones, and your phone has all this data about you. And we can sort of underwrite people's credit risk using this phone data and provide them access to a very small loan. And it turned out that this solution.
I had a quick follow-up. But Tala was a consumer play, right, for individuals?
Well, that's what's interesting. Is actually when we began, it really was focused on, well, I think in short, I'd say it's like use case agnostic.
Okay.
I'm
just trying to think of what data it's pulling off the phone and what decisions it's making off that data.
Yeah. It's a lot of it is individual data, but the reality is, many small businesses are just sort of sole proprietorships. And so let's say we're underwriting.
It's interchangeable whether you're assessing the individual or the business. Right?
Yeah. Let's say you're underwriting someone's mobile money receipts, and they have a lot of transactions that's like 100 shillings coming in because they're selling bananas on the roadside. Would you call that consumer or small business? It's hard to say. Sometimes the path kind of blurs.
That's MSMEs all over the world, right?
Exactly.
Yeah.
Yep. Cool. And but I do think you're right in that a lot of these mobile lenders, the initial aspiration was really to provide financing for small businesses to expand. But what ended up happening is these loans are often used for consumer use cases. And in theory, there's nothing. Who's to say what anyone should spend their money?
As long as they're paid back, right?
Yeah. As long as you're paying back, it works. The challenge is the more consumer the use case, often the more risky it is to get paid back, right? Because if you're financing inventory for someone's business and that they're getting the inventory, they're probably going to have to sell the inventory. But if you just give them cash and you don't know that they're going to buy the inventory they said, and instead they end up using it for something for their household, and who's to blame them for buying groceries for the household, but it might not be a productive asset that they can get a return on. And that person might end up getting trapped in a cycle of debt that they aren't prepared to pay.
Right.
But I'd say what left me ultimately to think of a path beyond just mobile lending is I saw that while that model scaled, it really got away from the community ownership element of microfinance 1.0. And in Kenya, we'd have our borrowers ask us quite often. They'd say, hey, in our SACCO is like a savings and credit cooperative, after we repay our loans, we put our money in and we get shares. And we've been taking your guys' loans for a while now. And we know this company's worth a lot. We'd love to have, can we have shares? And there's no good way for a US company to distribute ownership around the globe. But if we represent ownership on chain with a token, we actually have this new sort of innovative approach, a new type of business model that can let us sort of build a cooperative community-owned business at scale. And so the idea of GIA, like in its essence, was to take the community ownership element of microfinance 1.0 with the scale of microfinance 2.0. And so what we do today to implement that is we provide inventory financing and invoice financing, mostly sort of working capital for small businesses in emerging markets. Today, our two markets are Kenya and the Philippines. And we basically source that capital on chain, on the blockchain, which lets anyone provide liquidity, which we then take to use to finance small businesses. And when they repay, the idea is that they earn token rewards, which sort of gives them an ownership stake in this business.
Okay.
So,
and those tokens are ultimately convertible into currency on an exchange.
That's right. Yep.
Okay. So a couple things here. Well, let's focus on Kenya as much as we can. I know you're operating in two different markets. So Kenya, why Kenya? Was it just, it's typically one of the five markets everyone starts a fintech company in, right? But why Kenya?
Yeah, a couple of reasons. I mean, one, just us personally, I've worked in Kenya for the past 10 years, and it helps to work in a country, you know. But the macro fundamentals, the reason so many fintech companies get started in Kenya, of course, is because there's more, broader digital financial services and mobile financial services adoption there than anywhere in the world. I mean, the M-Pesa story of...
I was going to say, did M-Pesa really pave this road for
Definitely for everyone. I mean, that's why mobile lenders all started there. It's why pretty much every fintech company. I mean, you have so much more data to underwrite in a country like Kenya than you do pretty much anywhere else. Because just by looking at someone's SMS receipts, or people can even take control of that and upload a PDF statement of their M-Pesa history, and all of a sudden, there's so much more data to underwrite against versus if they're just doing everything in cash.
Okay, so walk me through a typical use case of a Kenyan MSME, if you can.
Yeah, typical use case would be there's this guy, I always like to shout him out because he's a great sort of champion of GIA. His name is Francis Njoroge. He's in Githurai Market in Kiambu, just sort of outside of Nairobi. And here's a guy who sells spices, fruits, and vegetables in a local market. I think you probably recognize a lot of businesses just like his. He's a very entrepreneurial guy. He actually, he's branded his spices. He has his own sort of like trademarks called Emperor Yard Spices. He makes biryani mix, a pilau mix. His store smells great. Anyway, so I was with him hanging out once, and basically he mostly sells spices to local consumers, but also restaurants in his community. And so I was there, and a nearby restaurateur came by to buy some sesame seeds, and I think he needed something like 5 or 10 kgs of sesame seeds. And Francis was like, "Oh, I'm sorry, you got to come back tomorrow." And I was like, "Well, why? What happened? Is this an often occurrence?" And basically what Francis said is, Francis buys the sesame seeds in 25 kg shipments because the next increment after 25 kg is 100 kg.
Mm-hmm.
And the jump from that is a considerable more capital is required. Now he could be paying a way lower unit price, so his margins could be way higher. And
if he's buying more. Yeah.
And he could keep more inventory in his shop so he wouldn't run out. He'd be able to make that transaction. So simply because he didn't have access to capital, he's having lower margins. He's not able to execute a business, right? And
it costs more to spend less sometimes. Yeah.
Yeah. And so that's like an obvious use case of someone who needs finance. And so that's what we do. Actually, we help Francis finance his inventory, and now he can buy at higher quantities at lower prices.
So, where is your biggest? Now, your data de-risks this for you to a certain degree, and the ability to talk through kind of your process for scoring. Do you have a proprietary credit scoring model, for example?
Yep.
Kind of walk us through how you've thought that through.
Yeah, we do. And a lot of this is not really rocket science. I mean, traditionally, What are businesses trying to do? What's a lender trying to do when they underwrite someone? They're trying to see, does this person have cash flows in a dependable, productive business that money is going to keep coming in so they can repay the money we're giving them up front. And so our underwriting engine takes in, I'd say it's really a couple major buckets of data. So one is is partner data. We typically work with local partners. These could be wholesalers or suppliers. Like you can imagine, we tie up with wholesalers, the folks who would sell spices wholesale to a guy.
One selling the sesame seeds to your...
Yeah, exactly, right? So we see, okay, Francis has been buying 25 kgs of sesame seeds every week for the last 2 years. We know he's a reliable guy. Let's finance some of that. So a lot of that is partner data. It could be just purchase history, any other data that some of the partners have. For example, some of them have inventory management tools. So we get to see a bit more insight into the business.
Yeah.
There's also other data that we get directly from the borrower. Sometimes they might upload their bank statements or their mobile money statements. Of course, we take their KYC and we run a credit reference bureau check. And then a lot of that, we're basically running through a model to get some derived information to understand, okay, what is this person's actual income and what is their debt to income ratio going to be? Because we don't want to over indebt anybody. So that's really what the engine says. It's what's helpful is then it sort of is continuously learning. So once we get the feedback of, we've given someone a loan and then it's time for their repayment, the model gets to learn and it says, okay, this is the characteristic of someone we approved for this much and they defaulted. We've got to change the model a little bit. And they repaid. We've got to reinforce the model. There's then a separate model for repeat loans. So maybe on your first loan, we make you eligible for $500. But we know that your business can handle more. So now we're starting to ladder you up from 500 to 600 to 700 and so on.
Okay. So what are the most important KPIs for your business in deciding whether your business is working? Default rate is the obvious one, of course, but what are some other metrics that you kind of rely on to know, is this working or not? When I need to turn the dials up or down?
Yeah, I think the most, one of the most helpful ones, obviously repayment rate is helpful, but even more helpful than that, I think, is repeat retention. So you don't just want to see that a borrower repaid, you want to see that they came and took another loan from you, because that's
right. They repaid and then wiped their brow in relief. That's not what you want, right?
Yeah, you don't want them to say, okay, thank God that's over. I'm done with them. You want to see them coming back. Often these products, they aren't one-offs. It's not like, I just bought a house and finally I finished paying my mortgage. Now I'm done. This is working capital for their business. They probably are always going to need some working capital from someone, just like you might always need milk or bread for your household. So it's a question of where are you going to go back and get your next milk and bread? Where are these guys going to get their next bit of working capital? So the most important KPI for us is really repeat retention. And we want to see borrowers stick with us. We don't want folks churning out either through, obviously not through their fault, but through choosing to
well, no, that leads to a question about competition then. Is your fear that they go borrow from someone else or that they just stop borrowing? I mean, what is the bigger risk for you?
Oh, if their business is self-sufficient enough that they don't need to take credit anymore.
Well, yeah, of course. That's great.
Yeah, I would never say, hey, come back to the debt.
Right. You're cash flow positive. What's wrong with you? Yeah.
Yeah, that sounds great. I do think the reality is, most of our borrower segment are probably always in need of some financing, even if they do get to a point where they're cash flow positive. These are entrepreneurs who always have their eyes out for their next opportunity.
Yeah, you want to add a store or whatever it is.
Yeah. Like once you get to cash flow positive, what are you going to do with that money? I think people generally have a sense that money sitting around sort of burns a hole in their pocket. So they'd like to find real estate to invest in or some livestock.
Right, of course.
Asset.
Yeah. So are you thinking of moving up to larger lending opportunities then?
For sure. Yeah. The idea of starting with smaller inventory financing is it gives us a chance for small businesses to sort of prove it's a relationship. We each get to know each other. We get to show them, hey, we're a reliable, affordable finance partner for your business. And they get to show us, yeah, we're reliable and we repay on time. And after a few iterations of that, then we can actually provide asset financing so that Francis doesn't just have to be buying, chili powder on credit. He actually could invest in another shop or maybe even a new spice mill.
Okay. All right. That makes sense. So I want to go back to the blockchain component of this. I'll just ask it this way. Was it a better idea when you looked at it at the time than it is now? Or talk about how you see that going forward. Is that a long-term fundamental piece of the business?
Yeah, I really think of applications of blockchain. You have to look at it from a longer lens. I don't really view it in connection with like crypto hype.
I know crypto is an asset class, blockchain is a technology. I understand the difference between the two. And there's probably even a more profound difference between the two. That said, still, you're, that sort of was the nature of the question.
Yeah, no, I think the benefits that blockchain can bring for any business that's serving multiple geographies can be pretty profound in terms of reducing the cost of moving money across borders.
Right.
Not just for us as a lending company, but even for small business borrowers. So I think one thing that I've been surprised to see is a lot of businesses that we serve in Kenya, for example, maybe they want, if they're importing something from abroad, basically what generally has to happen is they have to get their Kenyan shillings into US dollars just to make that transaction. So a very common thing, say you're a Kenyan bakery and you're importing sugar wholesale from a sugar producer in Brazil. You have to get your shillings into dollars, probably through some bank in Dubai, which is very expensive, just so you can pay this Brazilian sugar producer in dollars. And then they have to do the hard work of getting it back into Brazilian reals. So everyone's sort of like feeling this is kind of a pain in the butt.
There's a lot of steps and a lot of payments on each of those steps. Right?
You're losing a lot of money every time.
Everyone's getting a cut along the way.
And there's central bank currency controls. The Central Bank of Kenya might not want you moving that many shillings out of the country, and it's really expensive for small business. Mm-hmm. You have a lot of folks who are just paying a pretty high tax just because of the fact that they live in a certain country. I mean, currency devaluation happens. People who have Kenyan shillings today have like 30% less purchasing power than they did a year ago, and that's a pretty unfortunate situation.
That's massive,
for someone to find themselves in. And by representing, U.S. dollar stablecoins are a great opportunity for more and more businesses to just participate in, I guess, a more fair economic playing field. So we source capital on chain in U.S. dollar stablecoins, and of course we give folks the option. We can off ramp it to them and just provide it to them in fiat currency and Kenyan shillings, and many people want that. Mm-hmm. But increasingly, many are going to want to actually keep those loans in U.S. dollar stablecoins and use them that way.
Right. So that was my sort of follow-up, is how receptive how receptive are your end users, the borrowers, to the notion of blockchain? And is it transparently explained to them, or is it sort of in the background and doesn't matter? I mean, you know what I'm...
Mostly it's in the background and it's abstracted away. If you're when you use your Chase credit card, like, does Chase come up to you and say, "Hey,
no idea what's going on.
The money that's provided to you on your Chase credit card went through the 25 payment strip"? Who cares? I just want to be able to swipe.
Yeah, exactly. No, fair enough. I had this conversation recently with someone about AI in small businesses and how all these AI tools are being developed to help small businesses do this, that, and the other thing. And my point was, they probably at some point will not be described as AI tools. They'll just be like, here's your automation tool, or here's your digital assistant, and it's AI is doing all the work. They don't have to know that, or they may not care, And probably very similar.
No one needs to know. Even imagine like the credit underwriting. Do we say to a borrower, like, your data is being analyzed by these 6 machine learning modules? Like, no, because who cares? Give me the loan or don't.
That's exactly right. So I kind of assumed that was the answer, but I thought I would ask. Yeah. Okay, so talk about your ambitions going forward for GIA in Africa.
The main goal is really just to be small businesses' partner in growing what they're doing. And we think of that obviously initially in financing, but I think there are a lot of other areas that we can be a real helpful partner. One thing that I've heard throughout my time working in microfinance from small businesses is not just, hey, I need capital, but as often I need resources to help me spend that capital more efficiently. I mean, that could be something as basic as some like entrepreneurship education. But a lot of it is sometimes like creating a community. People want access to cheaper supplies. So like Francis might be stuck with one spice wholesaler, but if he's connected to other local spice vendors who have better connections, maybe they're able to bond together and buy in bulk and access even better costs. Most banks, most lenders do not provide that kind of community. But typically these communities exist offline. Francis is already in 20 WhatsApp groups of local vendors, but they're all kind of like disaggregated. They're not all connected to the same financial partner, and they should be. Why not, instead of having them sort of coordinate across these distinct lines, why not say, hey, you can all bond up and take a social line of credit from GIA? So we really think investing in community is a really big piece of what we're going to do. And in the long run, we want to help folks not just finance their business day to day, but actually build wealth and prosperity in the long term. And so that means
Is it like financial management tools and things of that nature, or?
that's right. Yeah, we want to help people save and invest and build
Mhm.
reserves for the future.
You said something very interesting just a moment ago, which was the whole idea of Francis is in these multiple WhatsApp groups. Do you have more thoughts on how aggregating those groups could be an opportunity,
And of course,
and
yeah, think about
what is the enabling technology that would be make the most sense there? If you have thoughts on that.
yeah, think about the fact that each one of those individual vendors, like let's say they're all spice vendors, or let's say like they're all just like individuals. Who knows really what they do?
Mhm.
Every one of them, when they go to a bank, probably cannot access a loan. Maybe even every one of them, maybe of all of them, the only one who would currently even be able to access a GIA loan is Francis, because we maybe worked through a local wholesale partner and we got access to
Mhm.
him and have proprietary data about him. But imagine if you could quantify all that data that's in a WhatsApp group that shows, oh, this is someone who's been providing this much, they have these insights on how you can save, they have these insights on how you can sell, they have these thoughts on how you run a digital marketing ad, right? That person should probably be eligible for something, but currently is not. And I think the sum of that WhatsApp group community's like purchasing power is way greater than like its individual parts, right? If they could all just
Mhm.
be tied up together. And I don't think anyone's really cracked that nut of providing a community finance or social finance product at scale. And I think we're really interested in doing that. And what we already see, I mean, our highest, our biggest source of new borrowers is from referrals. I mean, Francis alone, I think, has referred like 20 borrowers to us from
Yeah.
the local market. And that's because there aren't a lot of great options out there. So once you find someone who's working for you, you want to, let your community know. But rather than serving Francis and each of his 20 referrals on a one-on-one basis, what if we could serve them at a lower rate, just with one big loan, and they sort of manage it together? I think that's like a great application of something in the future.
Okay, cool. What about geographically within Africa? What are your thoughts in the near term?
Very excited to explore markets beyond Kenya. I think
Hmm.
the natural thing that I think a lot of foreign venture-backed companies do is they sort of look at like Kenya in the east and Nigeria in the west, and maybe South Africa's too advanced for them, and then sort of like prove something in those places, and then see where they can go from here. I think that's sometimes like just basic like Western VC math. I think we'd probably be interested in exploring countries that aren't just.
BBC wants you in Nigeria within 18 months or something like that.
Yeah,
Yeah.
I think that, and it would be really exciting to be in Nigeria, but it's also a very competitive and complicated
Yeah.
and expensive market. And sometimes it might be a little easier to enter somewhere else. We actually have an invoice financing program going right now with a company in Ghana, which is really exciting.
Hmm.
Company there that sort of has basically they have like a financial health management software for MSMEs in Ghana, and we're working with them to.
Is it Oze?
It's called Oze, OZE.
Yeah. I know Megan. Megan from Oze was a speaker at our last conference.
Amazing. Yeah. So we're working
Yeah.
with Megan and providing them invoice financing. It helps also her brother is a pretty prolific investor who invested in.
Packy. I follow his newsletter, and
Oh,
he's an investor of yours.
yes, exactly.
Okay. I did read a little bit before we talked.
Amazing. Amazing.
Okay, well, that's probably not a bad place to wrap it up. Really exciting stuff. I'd like a final thought from you on just what do you think from a macro level? Forget what you're doing. Just from a macro level, what are a few things that you'd like to see happen in the next few years that would help small businesses in Africa?
Great question. I think, well, there's still a lot of work to be done around just like the basic financial infrastructure of getting more small businesses into the digital financial services world, right? Like I mentioned earlier, I think the reason why so many folks are in Kenya is because there's so many fintechs are able to serve folks in Kenya is because there's so much data around them. So governments could do more work to sign up more small businesses for bank accounts, for example, or for mobile money accounts, and to do more work to provide low cost, easy to use payment gateways so that more small business transactions can happen in a digital fashion. As we know, cash is very expensive. And so the lower reliance on, but it's also very convenient, which is why people use it.
Sure.
So the more governments can do to move folks from cash towards digital economies would be really powerful, as well as sort of strong KYC regimes. Sometimes it's really difficult for fintech providers to come in and do anything if they don't really know who their customers are. I think a really important development that needs to happen, frankly, everywhere is is having more robust credit reference bureaus. So in the 10 years or so I've been working in Kenya, the Credit Reference Bureau still, I think it only recently started really incorporating data from digital lenders. So that meant, if you borrowed from a bank, you were covered, but only like the top 5 or 10% of the population is actually borrowing from banks. Everyone else is doing it from maybe these mobile fintech lenders. And there's no real-time information. In the US, if I apply for a credit card from Chase and then another one from American Express and then another one from SoFi, eventually I'm going to get dinged and they're going to say, hey, you just are applying for credit cards left and right. And we're going to pause you on that.
Right.
But in Kenya, there's nothing that stops that. So you can be taking a loan from Tala and Branch and Mshwari and all these other providers at once, and you're just stacking them on top of each other. Really bad for you as a borrower, but also bad for the lenders.
No, it is. That's a problem in buy now, pay later as well, which I know is not this, but that is a similar problem. Yeah.
Totally. We just need better insight into how people are treating credit, because it is kind of it's like a medicine. It can be really helpful, but it can also be abused like a drug.
Yeah. Fair enough. Okay. Probably a good spot to end it on. Thank you very much for joining us today. It was a lot of fun.
Perfect. Thanks, Charles. Appreciate you having me.
Thanks for listening to the BIG5D Podcast, the voice of small business digital transformation in Africa and the Middle East. This podcast is a production of Big5 Digital and is written, produced, and hosted by me, Charles Laughlin. Please subscribe to this podcast wherever you listen and kindly give us a rating and a review. This will help others find us. Thanks again to our guest, Zach Marks, and to our sponsor, Duda. Please remember to visit them at duda.co. That's DUDA.co. Thanks for listening, and see you next time.